There's a 42-year-old software project manager in Denver. Smart guy, financially disciplined. For 3 years, he's been making $600 in extra mortgage payments every single month. His balance is dropping. He feels ahead. He feels responsible. What he hasn't calculated? That decision is costing him $432,000. I'm Stella, and today I'm going to show you the math behind that number, because there's a good chance you're making the exact same mistake right now. Here's what nobody tells you about paying off your mortgage early. Every extra dollar you send to your lender earns a guaranteed return equal to your interest rate. His rate is 3.2%, so he's earning a guaranteed 3.2% on every extra dollar he sends. That sounds reasonable, until you look at what that same dollar could earn somewhere else. The S&P 500 has returned approximately 10% annually on average over the past 50 years. Adjusted for inflation, the real return is closer to 7 to 8%. So here's the actual choice he's making every single month. That $600 in extra payments, kept on schedule for 24 years, will save him approximately $35,000 in total interest. Real money. That same $600 per month, redirected to a Roth IRA and invested in a total market index fund at 7% average returns for 23 years, grows to approximately $432,000 of permanently tax-free retirement wealth. He is trading $432,000 for $35,000, and here's the part that makes it irreversible. The Roth IRA contribution year cannot be undone. Every year he delays is a year of tax-free compound growth he will never get back. His mortgage will be paid off either way. The only question is whether he gives up $397,000 in the process. Now let's make this even bigger, because his situation is not unusual. It's the majority. According to Federal Reserve data from 2025, approximately 73% of all outstanding mortgages in the United States carry an interest rate below 5%. Nearly 60% are below 4%. These are some of the cheapest loans in the history of American mortgage finance, and millions of these people are prepaying those loans aggressively every month, believing they're being smart. They're choosing a 3% outcome over an 8% outcome, at scale, for decades. There's also something even most financial people miss. A fixed-rate mortgage is the only consumer loan that gets cheaper in real terms every single year, automatically, without you doing anything. Homeowners who locked in 30-year mortgages at 3% in 2020 and 2021 are now repaying those loans with dollars that have lost 15 to 20% of their purchasing power. Their effective real interest rate is near zero. Prepaying that debt with today's more expensive dollars, to avoid repaying it later with cheaper dollars, works directly against your own economic interest. So when does paying off your mortgage early actually make sense? If your rate is above 6.5%, the math changes. The spread between your debt cost and expected market returns narrows enough that prepayment becomes genuinely competitive. If you are within 5 years of retirement, eliminating your mortgage payment directly reduces how much your portfolio needs to generate every month. That matters enormously when a market downturn hits right as you stop working. And if you know from your own track record that you will panic sell investments during a market crash, the guaranteed return of mortgage prepayment may produce better real outcomes than the theoretically superior return you'll abandon at the worst moment. But for most Americans, none of those three situations apply. Here's the sequence that actually builds wealth, in the right order. First, capture every dollar of your employer 401k match. That's an immediate 50 to 100% return before a single day of market performance. Do this before anything else. Second, eliminate all high-interest debt above 8% APR. Credit cards first. Always. Third, build a liquid emergency fund of 3 to 6 months of expenses in cash. Home equity is not an emergency fund. You cannot access it when you need it most. Fourth, max your Roth IRA. That's $7,500 in 2026. Fifth, max your HSA if you're eligible. Triple tax advantage, deductible contribution, tax-free growth, tax-free withdrawal. Sixth, increase your 401k toward the $24,500 annual limit. Seventh, and only seventh, if all of the above are fully funded and your mortgage rate is above 5.5%, the extra principal payment conversation becomes genuinely interesting. Below 5.5%, A low-cost index fund almost certainly outperforms mortgage prepayment over any time horizon greater than 15 years. The sequence is the strategy. Getting the order right matters more than optimizing any single step. Here's what to do tonight. Look up your mortgage rate. Open the free compound interest calculator at investor.gov. The link is in the description. Type in what you're currently sending as extra principal. Type in 8%. Type in the years until you retire. Compare those two numbers honestly. The guy in Denver hasn't run that calculation yet. Most people haven't. The mortgage will still be there after you do. The compounding years you delay will not come back. If this changed how you think about your mortgage, subscribe to Stella Insights. Every day, one financial decision explained clearly. No noise, no agenda, just the math that matters. Run your numbers tonight. See you tomorrow.